Good morning, friends. What we are going to discuss is the Ind AS 102. We have started yesterday, 12th July 2020, and the presentation is a full-fledged presentation has been already shared. So we are continuing the same presentation. That's the reason why the date is still remaining as 12th July 2020, because it's one single presentation which I have shared with all of you. If I'm changing that, you will have a feeling that it will be a new presentation. So it's the same old presentation which you have downloaded. Now, before we start today's discussion, I just wanted to recap whatever we have discussed yesterday, because it's a complex standard, and whatever we have learned for 3 hours yesterday and some of the questions which we have answered, you should be able to recap. That's the reason why I'm just recapping. The share-based payment transactions, Ind AS 102 covers when the entity makes a share-based payments either to the employees or to the outsiders. And we have said that when we are talking about the employee stock option plan or any other payment which has been paid to the employees, the accounting treatment will be little different compared to what you are doing with outsiders. And that is one thing which we have seen. The accounting treatment for employees and for outsiders will be different. And share-based payment need not necessarily only employee stock option. It may be even for a contract where settlement is not happening in by issuing your check or any other payment in cash, but you are issuing your entity's own equity instrument. That's what for the outsiders that we have seen. And next thing which we have seen is that what is the classification of the the share-based payments? We have seen it. One, we have said that it is basically either an equity settled or it will be a cash settled, or there could be an alternative which has been given. That means it is an equity settled with a cash alternative. That means either the party to whom it has been issued can exercise that option, or the entity can opt for deciding whether it's a cash alternative or it's a equity settled. So depending on that, we said that we will also account for the particular transaction. And we have also seen some 5 examples with the Excel sheets along with a lot of case studies to ensure that we are completely understood the concept and the accounting principle. Okay, just I am recapping the classification which we have talked about. One is equity settled share-based payments. The second is cash settled share-based payment. Is a quick recap of what we have seen. And the cash settled can further be classified based on whether the cash alternative is at the option of the counterparty. Counterparty means not the entity, the other party. For example, if the cash settled share-based payment has been issued to the employees, the counterparty is the employee. Suppose if it is issued to a supplier, then the supplier becomes the counterparty. So who will exercise the cash alternative? Suppose if the employee or the other party will demand the cash alternative and they have the option to demand for cash alternative, the accounting treatment is little different. This is compound instrument, considered as a compound instrument, and generally accounted as a cash settled accounting is to be applied. Why I have changed the color is that yesterday when we were discussing, we have omitted this particular point of what we call as a compound instrument. Okay, compound instrument is coming from Ind AS 109. I will touch upon this specifically because 2 questions which I said that I will come back yesterday. It is dependent on this particular point. If I have explained this issue, you may not have that question left out. Since I have missed to explain this concept, you are having that question. So now we will explain this concept of compound instrument and what is the accounting treatment comes as per the compounding instrument. That is one aspect. And because of that, what is the accounting treatment on the date of settlement? Only on the date of settlement the issue changes. We will come into that. I will open the Excel file. Again, I will go through that particular last settlement portion alone. 2 questions we have not answered. Okay, we will have that. The reason is we have missed to talk about this compound instrument. The compound instrument is actually coming from Ind AS 109. So I thought that I will omit it, but the accounting treatment on the date of settlement is depending upon this particular concept. So I have to explain that. We will do that. After I have recapped everything, I will come back and do this particular portion. The second is when the cash alternative can be exercised by the entity. That is, the employee or the outsider does not have the option, but the entity can decide whether it will be issue of shares or it will be paid in cash. If the entity has the option, we have to see what is the intention of the entity, because the entity, when it prepares the financial statement, it will be able to decide what is its intention, whether it is going to be issue of equity or it is going to be issue a payment of cash. If they have decided that, or the intention is to issue shares, we will go for equity settled share-based payment accounting. If it is going to be settled in cash, we will go for cash settlement option. What is the difference between these two? If it is an equity settled, at the time of settlement, instead of making payment, entities' shares are issued. When the shares are issued, there could be a possibility that the total amount of liability outstanding is above the face value of the particular shares. Number of shares which has been agreed, face value may be 10 rupees and the balance amount will be treated as share premium. That's what we have seen as equity settled share-based payment. So the settlement is happening by issue of shares. In a cash settled, it is nothing but a liability to be settled at a particular point of time where they are exercising the option, or where the entity decided to give cash alternative rather than equity issue. Okay. In that case, it is debit is to the liability, because the liability is accumulated, that should be extinguished. Debit is to the liability and credit is given to the bank account when actual payment is being done, like any other liability is being settled. This is the two core principle why we are looking into equity settlement and cash settlement share-based payments. Okay. And we have also seen employee versus non-employees. We have said that there is a different accounting treatment. And in the measurement principle, what we have said is, in equity settlement, it will be based on the fair value of goods and services received, because you may not be able to reliably measure what is the fair value of the shares. So accordingly, you are receiving something as a goods and services from the employee. We are actually taking the services, or from the outsider we are taking the services. So we normally go with the fair value of goods and services which has been received. And in case if it is not possible, we go with the fair value of equity instrument which are being issued. So what is the fair value of the equity instrument? At the measurement date, that is the date on which this particular measurement has to be made. In case if both are not available, we said we will go for intrinsic value of equity instrument. And intrinsic value, we have said, it is nothing but the market price minus the exercise price is the intrinsic value. It is not just book value of the shares. So we have said that, and we also said that the intrinsic value of equity instrument is rare. So it is very, very rarely it is applied. That we have said. And when it comes to cash settlement measurement, what we have said is it will be goods and services which are measured based on the fair value of the liability. So what is the liability which you have to pay? And the liability is remeasured at every reporting period. So based on the outstanding liability and what is the amount which you have acquired, you will remeasure the liability portion at every reporting period, and the difference will also go to the P&L account. This is what we have seen, right? In an equity settlement, you decide once, and that will be charged over the vesting period on a straight line basis. Suppose 3 years, 1/3 in each year. But when we are estimating this number, there could be a possibility of what is the number of shares which will be vested, because there could be some conditions that employees should be in employment for more than 2 years, and some employees might have left, and to that extent there is no requirement to issue them the shares, and the number of shares or number of options entitlement may come down. So fair value with the number of options we will identify, and the cumulative figure for the up to the particular reporting period minus what is already accounted in the P&L will be charged to the profit and loss account. That's what we have said, right? But we will not change the fair value. For example, the fair value on the date of transaction is 120 and it is going to be vested over 3 years period. 120 remains the same. Only the number of shares or what is the percentage of the people to whom it is vested, we will adjust. Whereas in cash settlement, even the fair value changes are increasing the liability or decreasing the liability. So it should be measured. That's what we have seen, right? And the types of condition is what we are going to see. Before that, what I will do is I will open that two Excel sheet which we have already seen so that we can discuss that 2 points which we have kept pending in the previous one. If I am not wrong, one question came on what to do in respect of the equity portion. That is in respect of illustration 3. So I will just share this Excel sheet. Then you will be able to see it. So you are able to see the Excel sheet now, right? Okay. So in this example, where we have said that the company has issued share-based payment with the cash alternative. So when there is a cash alternative which is also issued, what we have been told is that you have to see who will have the right to take the call or who has the option to exercise. For example, in this case, we have said the key management personnel can opt. That means not the entity, but the other party can actually exercise the option. That's what it is given in this example. And that is the reason why I said that I have missed to talk about compound financial instrument, because I felt that 109 will take care of it. But for understanding, when I am going back with your questions and looking at the institute material also, I found that we should explain what is compound financial instrument. Just for your information, simply the Ind AS 109, when you are reading it, you will find it out. Suppose if the instrument contains characteristics of both equity as well as liability, then the equity portion has to be separated, liability portion should be separated. Liability portion should be accounted based on amortized cost model. That means every period you have to revisit what is the increase or decrease in the value of that liability, and the difference between the opening liability and the closing liability will be debit to the P&L. That's what we call it as an amortized cost, or otherwise what we are saying here, your liability portion should be remeasured at every reporting period and the difference should be charged to P&L. What happens to the equity portion? Under Ind AS 109, when you are splitting the compound financial instrument, it says, for example, 100 rupees is the value of the compound financial instrument, and out of which the liability portion is estimated at 80 rupees. The balance 20 is the residual portion. That residual portion is considered as your equity portion. Very simply, it says the residual portion has to be considered as the equity portion. What happens is the liability portion is remeasured at every reporting period, but the equity portion is not at all remeasured. In our example of Ind AS 102, what it says is that if the option will be exercisable, cash alternative can be exercisable by the other party, it is considered as a compound financial instrument. And accordingly, you have to determine what is the liability portion, and the remaining will be considered as your equity portion. Okay. So that part of that, even though we have done, we are not linked it to Ind AS 109. I am just coming back to this particular scenario where we said if they are going for the cash equivalent, 1000 shares will be issued. If they are going to get shares, that is equity settlement, 1500 shares will be issued. So what we have said is with restriction, that is the shares which has been issued should be maintained for minimum 3 years with restriction. It is 102 is the fair value. So 1500 into 102 we have first calculated. That is what we have done, which is the equity alternative 153. And when you have taken this number, this is a compound financial instrument, and whenever compound financial instrument as per 109 says, first you have to identify the liability component and reduce it from the total carrying value. In our case, when to derive at the equity portion, we have only the cash alternative which is available. But can I say that that is the total liability? No, because worst case scenario, I will be having 1500 shares to be issued. So to determine this, 1500 into 102, which is equivalent to our 153,000 minus what is the number if I am going for equity option, cash option. 1000 shares, what is the price? I should take the fair value without restriction on the grant date, 113. So we are reducing that 113, finding out what is the equity option or the equity component of the compound financial instrument. This 40,000, according to us, it is the charge. 153 is the total charge, which is the amount to be recognized as employee stock option plan. But 113 is the liability component, 40,000 is an equity component. And this, when undergoes change, we are not changing this 40,000. That's what if you are seeing that the 40,000 remaining as it is, and it is accounted on a straight line basis. That's what we have said. Equity settled will not be remeasured, but the liability component will be remeasured at each reporting period. That's the reason why the fair value measurement in respect of equity portion has been continued at 102 into 1500 minus what is the liability portion, right? Whereas in respect of the liability component, that is cash settlement option, previously it was 113 rupees per share, now it is 120. The additional amount is considered as an increment in the liability portion. So we are revisiting that number. That is what we have done here. In the second year, we have calculated what is the number based on number of options, which is 1000 shares into 132 at the time of settlement. So we are taking that. In the first year, we are taking that number as 1000 into 120. But in first year, somebody has also asked that question. I think that I have answered that. Again, I am repeating. We have determined that the remeasurement of the value from 113, it has gone to 120. But the amount which has to be debited is for only 1 year because its vesting period is 2 years. So on that basis, divided by 2, 60,000 is debited in the first year. Okay. In the second year, the liability increases because the fair value has gone to 132. 132 into 1000 shares is 1,32,000 rupees, of which 60,000 already accounted for. Balance 72,000 is accounted as the expenditure in the current period, which we have seen it. But in respect of the equity settlement portion, we never made any changes because the fair value on the date of the grant should be determined and it should not be remeasured for the fair value changes. It should be remeasured only for the options outstanding. For example, 100% of the employees are not going to get it, only 80%, then 40,000 becomes 80% of 40,000. So to that extent, there is a remeasurement will come. But 40,000 is the fair value which has been determined. What we have done is, we accounted properly everything. That is the equity portion we have debited on a straight line basis 20,000, 20,000. And the liability portion based on the fair value at the end of each reporting period we have calculated. For that particular period we have debited. But when we pass that entry, I stopped at this level, right? So I think I have stopped at that level. I have not shown that 40,000 question. It was there in the answer, but I have not shown that. We have settled the entire liability. Okay. So when I have settled the entire liability, because it is a cash settlement, assuming that the employees are opted for cash settlement, the entire liability has been paid. 1,32,000 is the total liability which has been paid, right? This 132 has been fully paid. But the equity portion is still remaining in the equity because we are showing that number as what? In the first entry itself, we are showing that as part of equity portion in the financial statement. When we are recognizing this 40,000 is actually debited to our share-based payment reserve equity portion. Whereas what I am settling is not 172, I am settling only 132. So balance 40, what happens? That is what the question which we have missed to attend or explain, because I have gone on the presumption that 109 will explain that concept. But having seen your questions and also going through that, I thought that it's fit to discuss about this. What happens in a compound financial instrument under Ind AS 109 is the equity portion has been determined in the first date or when you are doing a split accounting. The total amount of consideration which has paid has been split into liability component and equity component. The liability component will be remeasured at every reporting period. So for example, entity has paid, in this example, 172 is the value of the liability component. And what we have accounted, 1,72,000 is the total value, out of which 132 is the liability component. And what is the balance is the equity component. Residual is the equity component, 40,000 rupees. So on day one also, in compound financial instrument under 109, we will take that 40,000 as part of other equity in the balance sheet. That's the reason why when you are saying share-based payment reserve equity means in not as a equity share capital, but in other equity. You might be knowing statement of changes in equity is one of the component which we normally see as part of Ind AS 1 on the financial statement. In statement of changes in equity, there will be columnar item for each type of other equity. One of the item will be equity component of compound financial instrument. You will show this 40,000 there on the first day where the split accounting has been done. In our example also, the first accounting which has happened is on this particular day, right? 1st January. But actual entries are flowing to the entity only based on, it is not a purchase of an equity instrument, it's a commitment to issue compound financial instrument. Accordingly, we debit 20,000 based on the expenses being accounted, corresponding increase in the equity portion. So 40,000 now sitting in other equity. What to do with that 40,000? Whether I will be issuing shares? No, because the entity has, the other party has actually opted for cash alternative. I have settled his liability in full. Cash alternative means 1000 shares into 132 rupees is the total liability. The balance 40,000 I need not settle to any outsider, but it's still sitting in my equity. Can I transfer that 40,000 as a credit? Because I am showing that as a credit in my liability side, that is other equity. So to remove it, I have to debit the other equity, and where the credit should be given. Can I give it to the profit and loss account? That's the area where we have not talked about. Somebody has posted that question twice, but I have gone further without explaining that. That 40,000 is not actually an expenditure, and it is not actually an outflow. When there is no outflow, it is only an adjustment within equity. So under Ind AS, whenever there is an adjustment which is happening within equity, you cannot debit or credit to the profit and loss account. So accordingly, what would be the entry which we will be passing here is to remove that particular 40,000. I will just copy this for an easy understanding. So share-based payment liability, which is now sitting at 40,000, I will debit that number. Okay, I will debit that number, and where I have to You are able to see my PPT, or I have, I will again share. I think that there is a network issue which has happened. So this 40,000, when I have this number, it cannot go to the P&L account. And accordingly, because my entire liability towards expenditure is only 132. And because it was having both the component, I have recognized in the profit and loss account. Can I reverse that employee benefit expenses? No. What the standard says is it has to be reversed within equity. That means one form of equity to another form of equity. I have this number which can be going to my retained earnings. I cannot take that to my share capital. So this is what the portion of the work which we have not discussed yesterday. So this is the entry for the 40,000 which we are talking about. Okay. This is mainly because of Ind AS 109. Ind AS 109, it is the equity component of a compound financial instrument. Okay, this should not be transferred to your P&L account. It can be transferred from one form of equity. This is there in other equity. Actually, it is sitting in other equity. From other equity, I am transferring to my retained earnings. That is also another equity. The only thing is now retained earnings will increase and this balance will get extinguished. This is one thing which we have not discussed yesterday. And another question which has come, if I'm not wrong, it is relating to illustration 104, illustration number 4. Let me see that number, then I will be able to realize. Yeah. Here, if I'm not wrong, Pushpak has actually asked this particular question repeatedly. I said that I will refer back to the institute material and I come back. What I have assumed is that this will be both with equity component. That's a compound financial instrument where the 3,60,000 should be transferred to equity. That's what I have understood, other form of equity. That's the reason why in this case also we have the same position. There is an alternative which is available either in cash or in equity, and it can be exercised by the employee. That means it is also a compound financial instrument. So I have assumed that because it's a compound financial instrument, whatever is the equity component of the compound financial instrument should be transferred to equity. That is what 3,60,000, if I'm not wrong in this example. Yes, it is nothing but we have determined what is the total value of the liability minus what is the fair value of the equity option if it is exercised. The difference we have considered as the fair value of equity component of compound financial instrument as per Ind AS 109. So this 3,60,000 is accounted on a straight line basis each year. If I am not wrong, 3 years is the vesting period. Yes, 1,20,000 each year. Whereas the liability component we have remeasured every reporting period depending upon the changes in fair value. At the end of the period, I have assumed in the example which I have given, 3,60,000 will move from one form of equity to another form of equity because it's a compound financial instrument. That's the reason why I passed the 3,60,000 entry. But the institute material, if I am reading, what they are trying to give is, in case if you are saying that this is a liability which will be opted, because they are saying what is the entry for option 1, what is the entry for option 2. But what I have done is I have considered only cash alternative option, and one form of liability has been paid and the balance amount 3,60,000 should be transferred to other form of equity is what I have done. But the institute wanted to give what is the journal entry for both the options at the time of settlement. One is if cash alternative has been chosen as an option, then you will make the payment in bank. And in case if the other party has exercised that, no, I don't want cash. Give me entire thing in share. Then we will issue share. That is the reason why in your study material, in both the options, the amount remaining to be 108,000, 1.08 crore, 78,000. Okay. That is the only reason where it is there. Pushpak was repeatedly asking this question, why you are taking 3,60,000? I passed the journal entry for only one option. Institute has taken entry for both the options for you to understand. Now, if we pass both the options according to the study material, the amount remaining the same, and you will be issuing shares to the extent of 108,000, right? Sorry, 1 crore 8,078, 1 crore 8,78,000 you will issue the shares. And what is the face value of the shares? Assuming that if I'm saying face value of the shares is 10 rupees and 1 lakh shares are issued, that the balance amount will be, 1 lakh shares into 100, right? So 1 crore will be the equity and 8,78,000 will be our share premium. This is also perfect. And what we are supposed to do, one more entry, that entry, because if I say that it's the equity settled, the share based payment liability, it is not liability, it is actually share based payment reserve, right? The reserve is sitting in other equity. What is the amount sitting in other equity? It is nothing but the 3,60,000 which will be sitting, because every time you are debiting 1,20,000, so 3,60,000 will be there. Where this will be sent, it will not be share capital, it is other equity. In other equity, when I use the word equity, it is nothing but retained earnings, which is again other equity. But share premium, whether it will come? No, because the share premium is only when you are issuing the shares. This will be the complete entry in respect of option 2, which has been chosen, because the 3,60,000 is still sitting in other equity. That should be transferred to retained earnings. Okay. I have only taken that 108 has been settled in cash because they have opted for cash alternative, and the balance 360 should also be transferred. That's what I have assumed. Now, because you wanted to pass the entry in both the cases, I have to consider, frankly speaking, the entry should be like this, even in the first option. Then only you will have that clarity. What I tried to do that is, I tried to do this entry. To remove this 360 also, I passed this entry. So that in the first option, entry 1 is this and entry 2 will be this, if you are selected the cash alternative option. Suppose if I am saying, no, I am not going to use the cash option at all, then it is the option 2. In option 2, the entry will be, again, you will settle that entire 108, which is the liability, because you are converting that into this. And this is the second entry which you will do to account for the actual issue of shares. Maybe I can even say that this entry itself, we can split that based on the particular transaction. That is a better choice for you to have a quick look. We can say 2 equity and 2 share premium. On the assumption that I have given additional example of 1 lakh shares at 100 rupees, then we will say this is 1 lakh share into 100 rupees face value, and the balance is this minus this, right? In that case, this entry is not required. So I will hide this entry for the time being. So this entry is not required. We have passed a combined entry. Right, this is first entry, but the second entry anyway has to be passed, because you have to transfer this 3,60,000. Okay, I have stopped at this level, which might have created a confusion. Now, Pushpak, you will be clear on what we are explaining. Okay. With that, we will go back to our slides to understand the balance of that. So nothing is now left out, and I am going to share my PPT to continue on the further discussion which we are going to have on this thing. So what happens is, we are talking about certain conditions. Initially, we have talked about employee should continue in employment for 2 years, then only he is entitled for it, etc. We have talked about now. The conditions can also have an impact on the fair valuation, or the conditions may have an impact on the value of the liability. So there are two things which has to happen. We have straight away taken the number from the fair valuation on the grant date, then started accounting if it is a equity settled. If it is cash settled, we decided that we will remeasure the liability at each reporting period, and then I will get into consideration. But in every example, we have seen certain vesting conditions also. For example, 2 years you have to be there. And then we have said that if you are using cash settlement option, the fair value of the shares are based on the market rate. When we are using the market rate, to put it in simple terms, it is a market condition. When I am saying that you have to fulfill certain service period, it is called a service condition. This service conditions and market conditions, non-market conditions, etc. has a bearing on the fair valuation. So now what we are trying to understand is how the fair valuation on the grant date is going to happen, and how it will be remeasured at every reporting period based on the terms and conditions of the issue. That is what we are trying to see, because the standard also talks about conditions will have an impact on the fair valuation or on the number of shares which you are supposed to issue. This is the two problems which we are going to have. So accordingly, we will try to understand what are all the conditions and what is their impact on the valuation. That is the reason why we are going to consider this. First question which we are having is whether any condition has been determined. Whether this condition determine what is the entity receives the service and what is the entitlement of the counterparty. Whether it is actually saying that based on this condition you will receive certain services, and because the services have been provided, the counterparty has a right to receive compensation for that. Okay. And relating to share-based payment, if you are talking about this adjustment in a normal contract, it's not share-based payment. If it is designated by means of share-based payment transaction, then we are seeing whether there is any conditions attached to that. If I am saying yes, only if you fulfill that condition you are entitled for it, we call that as a vesting condition. So that means, if vesting means I should be entitled for this amount to be claimed, so it is vesting. For example, even in Ind AS 19, your employee benefit, you will say whether it is a vesting condition on the employee or non-vesting condition of the employee. Same logic. Whether it is vesting, that means you have the right to claim as an employee or a counterparty. In that case, we say that the condition is a vesting condition. If there is no such condition issued, there is no vesting condition. So automatically everybody will be entitled for it the moment it started, that scheme has been started. Okay. Now the question is, the vesting condition can be subclassified into some other category, for which the question which we are asking is whether the vesting condition only, please understand the word only relating to specified period of service to be completed. Okay. So I am saying that it is only the service period. If the vesting condition is only the service period, we consider that as a service condition. For example, if any employee who is spending 3 years with the company are entitled for it, no other condition has been included. only condition is you have to be in employment for 3 years, right? Continue in employment for 3 years. So it is a service condition provided no other conditions are included in that. Suppose if the vesting condition contains both service condition as well as some other condition. For example, if I am saying you have to be in employment for 2 years and the EBITDA of the company should increase by 50%. So you are including two conditions, service condition plus some other condition. What we are saying, only if the service condition alone is there, then it is a service condition, or otherwise, if you are including some more condition, it says you should not consider as a service condition, you should consider as a performance condition. So if two conditions are there, you will ignore the service condition, straight away go for performance condition. Why service condition and performance conditions are important? Why vesting conditions and non-vesting conditions are important? Because it will determine what is the fair value of the amount determined on the grant date. And it will also determine what is the number of shares which will vest at each reporting period. So that is the reason why we are trying to understand. So if only period of service has been given as a condition, vesting condition, it is a service condition. If other than that period of service has been given, or it contains period of service plus other condition, it is called a performance condition. Okay. Vesting condition, non-vesting condition. Within vesting condition, service condition and performance condition. Now, the performance condition can further be seen based on whether the performance condition is based on the market price of the entity. In the previous example, I said EBITDA should increase by 50%. Whether the EBITDA is based on the market price of the equity instrument? Surely no. It is based on the performance of the entity and nothing to do with the market price of that, right? But you can say market price will also go up if the EBITDA goes up. But I am not relating that to the market price. Market price should go by 20%. If I have said that is a market price based condition. But now I am saying your EBITDA should go up. Sometimes my EBITDA goes up, okay, but my depreciation and other items or the non-cash items are huge. Because of that, I am incurring a loss. It may not have a direct impact on my market price. Market price may not be increasing based on the EBITDA increase, right? In certain cases. Accordingly, don't get confused. If EBITDA increases, market price will also increases because other factors will also influence the market price. If we say the performance conditions, assuming that in a share-based payment, we are saying employee is entitled for share-based payment or options which will be given, 1,000 options will be given to an employee provided he completes 2 years of service, period of service, plus the market price of the share should go up by 10%. So it is based on the market price of the equity instrument. And because we are saying two conditions are included, it is not your service condition. It is considered as a performance condition. Because of the performance condition is relating to market price, it is considered as a market performance condition. How the price, the company performs in the market will determine the condition, whether it's met or not met. In a lot of cases, we have said the fair value is 112 in the first year, 123 in the second year, 132 in the third year. Based on that increase, we have given that benefit to the employee, right? Because it's a market-based condition. We are remeasuring the liability. You can now infer how the condition is directly relating to that. Okay. In an equity settlement, what we have seen is it is a non-market performance condition. For example, EBITDA is the condition which I have included along with the service period. It is a performance condition because more than service period is also included. One more condition is also included. But EBITDA performance is not relating to the market price. It is internal to the entity, right? Because of that, it is considered as a non-market condition. Okay. Before we get into that, how it is impacting your numbers, let us try to understand non-vesting condition. Non-vesting condition is neither the issuing party or the counterparty can choose to meet. For example, inflation goes or increases or decreases within 5%, gold price movement. It is not within the control. I cannot even choose to meet this particular condition. So accordingly, it will be a non-vesting condition. Example I'm talking about. Whether counterparty will be choosing to meet it. For example, if I'm issuing a share and I'm saying that you have to hold it for 3 years. In one of the example, we have said that if the shares have been issued, it should be held for at least 3 years. That is the reason why they are giving higher number of shares because of the restrictive condition. Or you have to make the payment in respect of share purchase plan where some amount has to be regularly paid. So other counterparty agrees with that condition. So that is one possibility. And the third possibility of non-vesting condition is condition where the entity can choose to meet because it is within its control. One is I will continue the plan as per the terms and conditions. I will not cancel that plan. If I am cancelling or I am modifying, there is some other accounting treatment which comes in later point of time. This is an example of non-vesting condition. Let us understand certain examples to understand the concept of vesting condition, non-vesting condition, service condition, performance condition, market-based performance condition, non-market-based performance condition. So there are 6 items which we have discussed. Now, the entity has issued 100 shares each to its 1,000 employees in a share-based payment if they remain in the organization for next 3 years. Whether there is any condition, whether it's a vesting condition or non-vesting condition. There is a condition included. Accordingly, this is a vesting condition. Okay. First, we have classified the broad head. Within the vesting condition, is it only period of service is the condition? Yes, they have given only the period of service. If the period of service is the only condition we said, it is a service condition. Okay. So it is becoming a service condition. We are not going to the further because we got the answer straight away. Now, another example. Issue stock option to its employees who will serve the organization for next 2 years and till the time the share price reaches 100 rupees. Now what happens? Coming back to the original discussion, is it a condition attached to the option? Yes, because condition is attached, whether it's vesting or non-vesting, it is a vesting condition. Vesting condition, whether only the service period has been given as the condition? No, there are 2 conditions there. And accordingly, you cannot consider this as a service condition. In service condition, only service period should be the condition. So 2 conditions are there. It is not service condition. So it has to be performance condition because the entity should perform and the employee should also perform. Performance means 2 years they have to be there. Now, within the performance condition, we have to find out whether it is market condition or non-market condition. Okay. When we are talking about this, whether it is a non-market condition or market condition, we are talking about the share price should increase up to 100. So that means it is related to the market price of the equity instrument. So to that extent, it is considered as a market condition, market related condition or market condition. Let us take one more example. Here we are saying the same thing, 2 years, but we are talking about EBITDA should reach 10 crore. Going by that, whether it's a vesting or non-vesting, it is a vesting because there are conditions. In the vesting condition, only period of service has been given as a condition. No, there is one more condition relating to EBITDA. Accordingly, it is not a service condition, it's a performance condition. In respect of performance condition, whether it is a market-based performance condition or non-market-based performance condition. Market-based means it should be relating to the share price of the equity instrument. In this example, it is not based on the share price, it is based on the EBITDA, and accordingly, it is not a market condition, it is a non-market condition. Okay. Let's continue this example to understand this. because we said no, one more classification. What is that classification which we have talked about when we are talking about vesting condition and non-vesting condition? In the non-vesting condition, we have also talked about whether neither party will, this is what we have said, no, right? In the performance condition, in the vesting condition, non-vesting condition, we said counterparty will choose to elect, or entity will choose to meet, or nobody will be able to choose to meet. In that example, we will take one thing for understanding that non-vesting condition. What it says in this example, entity issued some stock options to its employees wherein they are required to serve minimum period of 2 years, and from the end of the second year, there will be further waiting period of 1 year, within which there should be achievement of revenue to 100 million. However, if an employee leaves the entity after the end of the second year, then the employee will not lose its entitlement to get such a share-based payment. What does it mean? They are saying service condition of 2 years, and entity should reach a revenue, that is a total sales of 100 million. Now we will come back right from the beginning. Is there any condition attached? If condition attached, it is a vesting condition. So in this case, it's a vesting condition. Non-vesting condition, nothing is there. Up to the second year. We will come to that. What do you mean by why I am using the word up to the second year? Because up to the second year, they have to be in employment for 2 years, and the entity should achieve a revenue of 100 million. Okay. So there is a vesting condition up to the second year. Then with the vesting condition, I have to identify whether it's a service condition or a performance condition. Service condition means only service period should be included. But here they have also said entity should achieve a revenue of 100 million. So more than the service condition, service period is also included. So it is not service condition, it is a performance condition. Within the performance condition, I have to identify whether it's market-based performance condition or non-market-based performance condition. When we are talking about market-based performance condition, it should be based on the share price of the entity, but in the market. So in this case, it's only achievement of revenue of 100 million. And accordingly, it is a non-market condition up to the second year. What happens up to the second year, you have to fulfill this condition. Once you have fulfilled this condition, they are extending this for further period of 1 year. Okay. That is, they are extending for further period of 1 year, and the further period of 1 year, in fact, I think that I am missing it. It is saying minimum period of 2 years. Okay. And from the end of the second period, there will be further waiting period. So there is one more condition. You have to wait for 1 more year without relating to anything to service. Plus they are talking about 100 million. But the moment you have completed 2 years, because the 100 million is not relating to 2 years performance. So I have confused. So the 100 million comes only after the second year. So 1 more year, third year, you have to achieve 100 million. So if an employee has completed 2 years of employment, what happens is that he will never lose the benefit, even if the performance condition has not met. So accordingly, this is a non-vesting condition from the second year. Up to second year, if I am entitled for it, it is a vesting condition. After second year, it is actually a non-vesting condition, because you are already entitled for it. Even if 100 million is not met, or even if you are resigning before the end of the 1 year, you are getting the full entitlement. And accordingly, this is an example of a non-vesting condition. Okay. You have seen vesting condition, service condition, performance condition. Within performance condition, market-based, non-market-based, and non-vesting conditions. Why we have spent so much of time in understanding these particular items? For a simple reason, how this will impact my measurement of the liability. which has to be accounted as an expenditure at each reporting period. Only for that purpose we are doing it. I have summarized the entire impact in a single slide, which you can actually see. What happens is, suppose if the condition is a service condition, that means only continuing to be in employment as per the terms agreed. In that case, there are two things which we have to determine. One is what is the fair value of the liability, right? On the grant date, that is on the date where both the parties have agreed. What is the fair value? First I have to determine. And every reporting period, whether the number of shares which has to be allotted, number of shares into what is the market price, based on conditions have been met or not. So in our example also we have said that because it's a cash settled option, your liability will also be increased to that extent of the fair value changes, right? So to determine how many shares will vest into what is the fair value changes, we have to consider what is the shares to be vested. One is to determine the fair value and another is expected equity shares that will meet the condition. Because the fair value into the number of shares which we will consider will have an impact with respect to the cash settled option. That is the reason why we are looking into this particular aspect. So let us take that. Suppose if I am saying only service period is the condition, nothing more than that. You have to be in employment for 3 years. Then you are entitled for 100 equity shares or 100 options which will be given after the end of the 3 year. In that case, there is no requirement to consider for the fair value of this particular item. Service condition is not taken into consideration. But for determining the number of shares at each reporting period, so I am saying that first year I have estimated 100% of the employees will be continuing to employment for 3 years. But at the end of the first year, when I have calculated, only 91% was there. So I have considered that the previous liability which I have fixed up is in equity settlement, it remains a constant number, but 91% will be entitled for it. So 91% is eligible for meeting the condition. So we are taking that number. For determining that, service condition is taken, but not to fix what is the fair value at each period. That is the reason why when you see in the example which we have taken, where service period has been given as a condition, we stick on to the fair value on the date of our grant. Whatever is the grant date fair value into how many people you are expected to meet and how many number of shares for each employee you are going to issue. That's what we have calculated. Because for determining the fair value which has to be taken, we will not apply the service condition. Suppose if I am saying it is a performance condition, but it is market related. If the share prices goes up, you are entitled for that. Your liability is fixed based on that particular scenario. In that case, fair value changes based on the market price at each reporting period. So I will revisit this number. And again, when we are talking about this revisiting the number will happen only in a cash settlement basis. In equity settlement, it's a simple thing. You fix the number, account it on this. But if it is a cash settled, then you have to do this. If it is with the cash alternative, then you have to do this particular activity. But the number of shares, where the parties which you are entitled for it, whether I have to determine that, definitely it will not have any impact because it's only talking about the performance, whether you have to stay in employment or not. Or because of that, what is the number of shares? Number of shares remaining 100. Market price goes to 120, you are entitled for 120 into 100. If the market price goes to 50, 50 into 120, which what you are, 50 into 100 shares, which I have agreed will remain in the same. For determining the number of shares, performance condition, which is market related, will not be taken into consideration. Suppose if it's a non-market condition, but it's a performance condition, that is the EBITDA should be met. In that case, you should not take for determining the fair value because internally it's not based on the market price at every reporting period, but it should be taken for whether there is a possibility of reaching that EBITDA or not. If the EBITDA is not going to be reached, then the entitlement becomes zero, right? So to determine how much possibility of reaching it, you will take into consideration. What is a non-vesting condition? In this case, you will take that to determine the fair value, because there is no restriction, right? You have to meet this particular condition or not to particular condition. You are already determined what is the amount you are entitled for, 100 shares or 200 shares. It is already determined. What is the number which we have to see? What is the price which is there in the market? Because fair value of the option which you have to work it out, that we will take into consideration. Suppose if there is no active market, if you have a question, will be determined based on a valuation, right? So here this will not apply. In simple terms, if you see this, service condition and non-market related conditions will be used to determine what is the number of equity shares which are supposed to be issued. Only for that will be used. Performance condition, which is market related, and non-vesting condition, no condition at all, but we have already determined what is the amount he is eligible for it. Those two items will be determined for the fair value of the liability, which has to be revisited at every reporting period. This you have to keep it in your mind. Let us take this example for you to understand. Then we will take an Excel example. The entity issued 100 shares, each to its 1000 employees, under share-based payment upon the condition to serve the organization for at least 2 years, subject to the below scenarios. So what it says is that, suppose the whether it's a vesting condition or not vesting condition, first of all, it is a vesting condition because service period has been fixed. The moment I say the service period has been fixed, it's a vesting condition. Within the vesting condition, I have to consider whether it is relating to your service period. Yes, there is a service period which has been given, which is 2 years. If there is a service period, what I am supposed to measure is what is the, going back to the previous one, service condition will only determine what is the amount, what is the number of shares entitled for it. That I have to decide. EBITDA is a non-market based condition. Again, when I am using EBITDA as a non-market condition, going back to our earlier one, it should be again decided only for the purposes of determining the number of shares. Share price should be 150 in the market in next 2 years. It's a market based condition. Then for determining the fair value, we have to take into consideration. The employee is required to serve additional 4 months from end of 2 years. So 2 years is the minimum period. Up to that, there is a service condition. After that, they have to wait for 4 more months. But the 4 months will not have any impact of whatever vested in year 2, like what we have seen in the previous example. Then the third will be a non-vesting condition. Okay. Let us try to understand each one as what is the condition, what is the not condition. First, up to the second year, there is a requirement to serve for 2 years. So it is to be considered as a service condition. Having said that, that is the only thing. Then it is not, it is a service condition, we stop at that level. Suppose if I am saying in every scenario, I have to consider this plus the other condition, then we have said only service period, then it is service condition, otherwise it is a performance condition. So when I am talking about performance condition, service period plus something is added. Assuming that service period plus EBITDA is added, then it becomes a performance condition, but non-market based, because EBITDA is entity specific. So the service condition and non-market condition will be taken to what? To determine what is the number of shares which will vest based on the share-based payment plan. Now, assuming that this is not there, only this is there, and the third one, share price is to be 150 in 2 years, then this and this may be a combination of, I will put this as A, this B as C. So A plus B will be a non-market performance. I will put a simple thing now, market performance condition. Okay, NMBC, PC also you can have NMPC, non-market based performance obligation. If I am saying A plus C is the condition of this, what it happens, it is a market based performance obligation. In market based performance obligation, what you are supposed to do, fair value has to be remeasured, because the share price, if it moves 150 from original 120, 30 rupees is also additional obligation entity incurs, and employee is entitled for that additional 30 rupees. So the liability should be remeasured. The fourth is what we are saying. They are talking about an additional 4 months, which we take it as D. In that particular scenario, what will happen? Suppose if I am saying A plus B, A plus C plus D. What happens? From the second year, because the entire thing will be tested up to, all these three are tested up to the second year, because till second year I have to keep this. This is vesting up to second year. But when I am talking about the last condition, this is after second year. After second year, what we are saying here is that will not have any impact. When I am saying it does having any impact, it is a non-vesting condition. In a non-vesting condition, what we will do? We will use it for determining the fair value. That's all, right? So the service condition plus market-based condition, non-market-based condition to determine the number of shares which will vest, and the market condition and non-vesting condition will be taken to determine what is the fair value. Clear now? That is the reason why I spent so much of time to clear this. So now I am going to take up one Excel working. Let me just see what are all the things which I am having. Okay. There are 3 items which we will see, illustration 6, 7 and 8, for which I am going to share my Excel sheet. Like last session, if I have missed anything, having not explained that, please make me give a reminder so that I will complete it, because I don't have another session for share-based payment. Today we will complete the share-based payment in full. Okay. So accordingly, if I missed anything and if you have any questions, please post it in your question box. I will answer those questions. Now, we will take the 5th illustration where we are talking about share-based payment towards a service. So that means its outsider is considered to be part of it. What we are having this, in this case, ABC Limited hired a maintenance company for its oil fields to provide maintenance services. How the maintenance services, the obligation will be settled by issuing 1,000 shares. By issuing 1,000 shares, and the 1,000 shares will be the period for which they have to do is 3 years. That means whatever is the fair value which I am determining should be accounted over 3 years period. At the end of the 3rd year, it will be share issue. So share capital will come into the picture. And what they are saying is fair value of the services is 1 lakh. That means 1 lakh every year, if I am not wrong. No, it is a total value. It is one full, this is for 3 years. Sometimes if it is confusing, we have to be a little cautious also. In this case, this is for 3-year full payment, 3 years charge, not 1 year charge. Be careful on that. Normally this type of information will not be there. Clarity will be there. In case clarity is not there, like what I assumed. I have gone and sorry, I have gone to the answer and saw that, because I don't want to confuse you with my answer and the study material answer. But if you do not have a clarity in the examination, whether this is for 1 year or for the full period, you can make a first point itself saying that the fair value of the service has been given as 1 lakh and the period for which the services has been provided is 3 years, and accordingly it is assumed that the 1 lakh rupees is for the entire period of 3 years. Make that statement. So even if in the answer key they have assumed 3 years into 1 lakh rupees, the benefit of doubt will be coming to you, because it was not clear whether it is per year, per annum, or it is for the full period. You may assume that because per annum is not there for the entire period. Okay. And what is the nominal value of share is given. In case if the final issue is happening at a price, then there is a share premium which may come in, right? That is the reason why that nominal value per share has been given. So now, if I am talking about 1000 shares, okay, I am just talking about my working notes, 1000 shares into nominal value of 10, the equity or share capital will be only 10,000, right? But what is the fair value which I am going to get is 1 lakh. So the balancing figure is what? The balancing figure is nothing but share premium. Okay, this is my working note for the purposes of understanding this particular situation. And we have considered that 3 years is the period. That means 1 lakh is the fair value. And each period I have to calculate what is the charge, which is 1 lakh divided by 3. So maybe 33,333, and last year it may be 33, 34, right? So this is what we have done it. Now, let us go and understand. What is going to happen on our accounting principle. What is the accounting principle which says you are getting a service, right? That's whatever I have done. They have calculated only the monthly expenses. Okay, sorry, I have considered that as a 3 year, but it's actually not 3 year. It is actually 3 months. Sometimes I will also get carried away with the X. It's a 3 months period. Okay, for 3 months, first month what is the charge, second month what is the charge, third month what is the charge is what we are going to find out. So the per month charge is 33,000 and odd, and last month it will be rounded off to another 1 rupee. Okay, so in fact you can have this as you can have this number as part of 1 rupee extra also you can put, because otherwise you will not get your 1 lakh rupees fully coming in. I'm just putting that so that 1 lakh rupees will be there. So what happens is, this is going to be equity settled. So every month I am debiting repairs and maintenance because it's a maintenance charges, and credit is given to equity. At the end of the third month, I am supposed to issue the shares, and this is where our people have done that. Our people have done that exercise of not rounding off, if I am not wrong. Yeah, they have not done the rounding off. This is one error which we will normally have. Whenever you calculate, I normally calculate in an Excel sheet like this, is equal to round off, and what is the decimal you wanted to have. You decide that, so that at the end of the period you will not have any confusion in your mind. In balance sheet, sometimes I have seen the client, when we gone to the audit committee, manually when we are totaling, the balance sheet is having 1 rupee difference because of Excel, which is a very dangerous situation. That's the reason why I ask all my team members, whenever you start with the calculation, multiplication or division, please always use round off. So in your examination, you are anyway going to use it a calculator. So accordingly, no issues of rounding off. If you are using an Excel for your practice, please be careful. But my suggestion is don't use Excel for your calculation when you are preparing for your examination. Put it in your paper and pen will speed up your working and answering speed. That is very important. So on the day when the service is fully provided, I have to change this as part of my equity shares. So equity shares face value is 10, which we have calculated 1000 into 10, and the balance is a share premium, so which we have to calculate. This is a simple understanding. Now I go for the next example. This is with the third party, right? Now we are talking about a market-based conditions, etc., which is given for an employee. Because normally this type of conditions, service conditions and market-based conditions are given only for employees and not for outsiders. That's another point which you can keep it in your mind. So in this case, what happens is that the share options are given to one of its directors, so only one person. So how many number of shares which will be outstanding, etc. This one is your real problem. So you have to be careful on that particular situation. So one is your, sorry. Okay. Review inking. My inking is not working. Sometimes technology is like my wife. It will never listen to me. Okay. So what has happened is, in this example, we are talking about, okay, this is the reason. Okay. This is the reason why I'm not getting that. So one of the director is going to get how many shares? 10,000 options are given. The options will get converted into shares, right? So they are getting 10,000 option, only one person. So 10,000 is the total option, 10,000 into 10. Number of years the manager is nothing but one of the directors considered as a manager. You can change it as number of years the director has to work. That's a better option. It is 3 years. So minimum 3 years. When it is fixed, is a vesting condition comes in. And the condition which also says is that over next 3 years, the share price should go up by 20%. So they have not given only period of service, they have also given what we call as the market price based condition. So it is not service condition, it's a performance condition. When it comes to the performance condition, it's linked to the market price, and to that extent, it is considered as part of your market based performance condition. Okay. So the fair value on the grant date is 120, and let us try to understand what exactly is the number which we are supposed to account for. The share price has moved as per below details, because what it says is that 20% it has to move, right? If it has moved to 22%, he is entitled for it in the first year, right? In the second year, it has come to 19%. So to that extent, in the second year, he is not meeting the condition. So he is not entitled for the value. And in the third year, it has gone to 25%. So on a cumulative basis, what is the number which we have to do it? Before that, let us particularly understand this particular condition. This is what I wanted to say. If the share price movement is a market-based vesting condition, what we have said, only the fair value determination you will use it. not for the purposes of number of shares. If it is service condition, you will go for the number of shares option. Because the fair value has been determined on the grant date, it will never go for any adjustment in the subsequent period. Okay, let us understand that, because if you recollect what we have said as a summary, for fair value determination, market-based condition will be taken into consideration, but it will not be taken into consideration for the purposes of what is the number of shares they are entitled for. It is not taken into consideration, and accordingly, even if the market condition is not fulfilled, there is no reversal in the expenses, because when we are keeping that 19% in the second year, there is a feeling which we will have that we has to reverse the entire figure, whatever we have previously recognized, completely in the second year is what we will have a feeling. But as it is only for the purposes of determining what is the fair value and not for the number of shares, number of options is fixed in this particular scenario, no true up will happen. This is an important point which you have to keep it in mind. So again and again go on practicing market-based condition, service-based condition, combination of both the conditions, or non-market based condition, non-vesting condition. Try to work out more and more problems with a combination of this, so that concept will very strongly sit in your mind. In this case, what we are saying, because it's a market-based vesting condition, we have to consider this expectation, whatever expectation, on the date to determine the fair value of the option on the grant date. Okay. On the grant date, what is the option value? It is 120. And what is the number of option which we are going to give? 10,000. So 10,000 is into 120 is nothing but your total number. Okay. 120 into 10 is 12 lakhs, and 12 lakhs which I have considered. If you by mistake, if you are taking the point that the share prices are moving to 19% in the second year and accordingly they are not entitled for it, you are ignoring one fact that market-based vesting conditions are not going to disturb your number of shares vested. It is only taken at the grant date to determine what is the fair value, right? Because of that, the fair value has been already determined 120 into 10,000 share, which is 12 lakh, and accordingly, even if it is not satisfied, he has already fulfilled the first condition, and whatever we are having, we are not supposed to true up. Okay. Suppose in this example, they have also mentioned something like service condition. Based on the service condition, if they are not in employment, the number of employees are expected to be in the first year only 90. Then what we will do, out of 12 lakhs, 90% is what we will consider in the first year as a total value, divided by 3 is the first year charge. Second year it is 95%. 12 lakhs into 95% divided by 3, divided by 3 into 2 minus what we have considered in the first year, because the cumulative amount has to come out, right? Third year, assuming that it's 100%. So 12 lakhs minus what is considered in the first 2 years, that should go. So in service condition, what we are taking into account, if there is a service condition which says you have to be in employment for 3 years, and in case if you are leaving, and they are also giving an example of how many employees have left the organization, then you will adjust the value of your options outstanding also. Whereas simple performance conditions, which is market based, you will not adjust anything. Only for that purpose I have brought in this particular example for you to understand. I think that you are clear on this. Okay. Now we will take a small variation on this particular question. In this example, what we are actually talking about is that we are talking about a company which is giving non-market conditions, not market condition. In market condition, the fair value determination alone has to be done. and you have to remain the same. In non-market condition, what we have said, you have to consider what is the number of shares which will be eligible or number of options which are eligible. Here, they have agreed to give shares to its employees. Each employee, it says 500 shares. So there are 500 employees on the start of the date. And what are all the conditions? Company's earnings should increase by 12%. It is a entity specific, not market based. So accordingly, it becomes a non-market condition. Second is, second year, if the earnings over the previous year should be 20% more than the previous year's earning. Assuming that the previous year earning is 10%, the second year earning should be 20% more than that number. So 10% plus 20% is, it should be minimum 12%, right? Third year, it should be minimum 22% more than the previous year. So that means you have to calculate the same way. They have fixed the increase in that. And they have also said what is the fair value on the date of the grant. So we have taken the fair value on the grant, which is 122 into 100 into 500 is the fair value of the total obligation. But this will change based on the non-market condition of whether you are meeting the criteria or not meeting the criteria. If you are not meeting the criteria, there will be a reversal which will be happening because it's a non-market conditions who is entitled for it. So they have also increased a lot of other points by saying what is the change in the increase. So first year it is 10% is the increase. What is the condition which we are saying? It should be 12% increase. It is a condition not met. And the first year, how many number of employees who have left the organization is 29 people have left. So accordingly, 500 is the number of employees, but who will be eligible for it will be minus 29. And the shares will be vesting in 2002. That means it is a 2-year vesting option. 2001 and 2002, yes, 2-year vesting option. So that means first year charge will be 50%, second year charge will be balance 50%. Additional number of employees expected to leave in the organization because in the first year, actual number also known to be, and there is an expectation based on the trend, how much people will leave the organization in the second year. For them also, there is no obligation on my part, right? So the 31 plus 29 should be reduced from 500. In the second year, you know pretty well what is the actual number of employees at the end of the period. That's the exact number. So 440 will be the basis. Now, in the second year, the earnings have increased to 18%. Shares not increased is 20%. Employees who have left during that period is 29%. And additional number of expected in 2013. Actually, it is a 3-year period or 2-year period. It is, okay, 3-year period. It's not 2-year period. I was thinking about 2-year period. It is actually 3-year period vesting. And in 2013, again, they are saying what is the employees who have actually left. So these informations are available. Based on this, we have to work out. First, what we have to decide whether it's a vesting condition. Yes. And second, what we are supposed to see, is it a service condition? No, because other conditions are also included. So we will forget about service condition concept. We will go to our performance condition. Whether the performance condition is market-based performance condition or not market-based performance condition. It is a non-market-based performance condition. So to that extent, the eligibility should also be revisited based on the actual measurement. That is what we are going to see here. Since the earnings of the entity is non-market related, it will not be considered for fair value of calculation of the shares given at each reporting period. However, for calculating the number of shares which will be vested, we will ensure that. And what is the fair value of the shares? That is fixed on the initial period itself. What is the initial period? That is 100 into what is the fair value on the date of grant? 122. So 100 into 122 or maybe 122 is the fair value per share. we will see what is the number of shares based on each period, right? 122 is the fair value which we have to consider. That will maintain throughout the period. It will not undergo any change because non-market conditions should not get adjusted for the fair value determination. Okay. It has to be adjusted only for number of shares. On that basis, we are going with our working. First, what is the total number of employees on the first year? 500. So same is the original number, out of which actually left persons has to be reduced because they are not entitled in the first year. And what is the expected number of employees which is given is also to be reduced. So 440 is the number of employees who are going to get that benefit into number of options, 100 options which has been given. And what is the fair value on the grant date is 122. And why I am considering that as half of that is that initially, if I'm not wrong, I think that they have changed the thing. Once again, I'm missing something. I think maybe I have missed to include a component. I think there is something missing in the question. 1st January, grant period, number of employees. On the grant date, it is 122. Okay, sorry, I have missed this. What it says is that in the shares will vest at the end of the year is the initial estimate which they have done, and accordingly it is going to be only 2 years, right? And later on they have changed it to say that they will also increase the period subsequently. That is, sometimes when you are seeing in examination point of view, whether it's 2 year or 3 year, which is not specifically given, but they have all in a sudden put it in 3rd year is coming here. So I was initially thinking about 3 years is the vesting period. But in the first year calculation, at the end of the first year, not even first year, at the end of the first year, they are saying that it is expected to happen at the end of the year. That means they expect that it will be happening within the end of the year. So within 2 years, they are expecting that in the first year it will vest. So that is the reason why the first calculation is actually vesting period is taken as half a period. Okay, it is not taken as 1/3. This is where I am getting confused. This is coming out of the simple reason they are using this word. This is a key for this question. It is vesting at the end of the year. That's a 2002. It is going to expect to be vested at the end of the period. So 2 years is the vesting period. So on that basis, it is taken as 50% in the first year. And what is the expenses which has to be debited? Nothing but 440 is the total number of employees going to be there into 100 shares into the fair value, which will remain 120 all over. But it is proportionate vesting period is 2001 and 2002. 50% is taken here. Okay. This 2684 is the total amount which has to be treated as an expenditure in the first year. In the second year, we are going to take the 500. If I am taking 500, I have to take the cumulative of people who have left. If I am taking 440 as the opening balance, then cumulative is not required. For example, if you see, I have taken the cumulative number of the employees who have left in 2011 and I have also taken what is the employees who have left in 2012, and I am also taking the estimated people who are going to leave in 2012. Here I should not use accumulated number because actual number has already come, estimated has to be added back. Other point of view is you can take this as 440 also in case if you wanted to do it. Only assumption in that case, you should not take this F26 also in that. So 419 is the number of employees into 100 into 122 is the fair value, but this is going to vest for 2/3. Okay, so 2/3 minus what was originally accounted 26.84, 7,23,867 is what is the number which has been allocated. And the third is 500 minus 58 previously left. And what is the additional number of employees who have left in the company in the third year? Sorry, actually this should be 2003. In the third year, there will not be any possibility of leaving the estimation because it's vesting period. So that should be taken as your 421 into 100 into 122 into 1. And what is the amount to be debited is nothing but cumulative amount minus cumulative amount already debited to P&L account. What is the journal entry I will pass? First year 2684 as employee benefit to, this is a share based payment, because of that I am keeping it as equity. And the second period is the amount to be charged in the current period. And third period is this number. And fourth period you are actually issuing share, so share capital comes in. If in this example, they have said what is the number of shares and what is the face value, then share premium has to be accounted for. Okay. Here in this case, only thing which we are getting confused is 1st January 2001 when we started, they are talking about 3-year period number, but don't get carried away because this is expected to vest within the end of the year. That means within 2 years, there is an estimation in the first year. Then there is a change in the estimation also for the third year. That's the reason why half, 2/3 and 3/3 is coming into the picture for your accounting. Now, 8th, we will see this also. Okay, this is a reversal. What do you mean by reversal? Here we are saying non-market conditions. One of its managers, okay, now I understand why the director has come. Copy paste of manager, Control C, Control V of Excel sheet. One of its manager, 10,000 shares are given. 3 years is the vesting period, and the cost of production should increase by 10%, reduce by 10%. So accordingly, 2 conditions are included. It is a vesting condition, but not service condition, it's a performance condition. In performance condition, it is relating to entity's cost of production. So it is not based on market condition. It's a non-market condition. In respect of non-market condition, what we are supposed to do? We have to take into consideration non-market conditions for determination of the number of shares which will be vesting, right? So we are trying to find out what is the cost of reduction. 12% is the first year, 8% is in the second year, 10% is achieved in the third year. Okay. In that case, whether in the second year I have to reverse the expenditure which I have previously recognized, the answer is, let us try to understand. It is a market related condition. Hence, achieving the target reduction of cost should also be taken into consideration of what is the number of options which are eligible. If I am meeting the condition, the entire options will be outstanding. If I am not meeting the option in that particular period, I am not entitled for anything. So 95 into 10,000 is the fair value of the option, where I am not going to disturb that because it should not be done with respect to non-market condition, only for market condition. So I have taken the 95 into 10,000. That is what I am not changing the fair value. It remains as it is. But what is eligible is first period reduction should be minimum 10%. By we are saying first period they have not they have actually achieved. So they are entitled for it, which is 1/3 of the total amount. So 95,000, 9,50,000 into 1/3 will be 3,16,000. But in the second period, the cumulative amount which I am supposed to take is based on what is the achievement. The achievement is only 8%, so they are not meet the target, and to that extent it will impact the number of options which are vested. Number of options which will be vesting will be 0 because there is no period outstanding. Instead of taking this as 0, I'm just taking it here. You can have in any manner. You can put a star mark and say it is considered as 0 because it is not meeting the criteria. So in that case, the cumulative amount to be recognized is 0 here, but I have already recognized 3,16,667. So to that extent, that number should get reversed in the P&L. Non-market condition reversal will also happen if the market condition is not being met. Similarly, only employee service period option has been given. Your amount will be based on whether you have, what is the number of people who are going to be achieving that particular service period. You will adjust the fair value of the debit. If that is the reason why every period we have considered what is the number of people. So in this case, because I have not met the condition, I am not entitled for it. So whatever I have already recognized should not be there. I am reversing it. When I am reversing, it is a reversal of the estimate. So it's a change in estimate. So nothing to worry about whether I have to restate the previous year number. In the third year, they have actually met 10% of that. The total amount should be 9.5 lakhs. What is the cumulative amount so far recognized is 0 because 316 has been fully reversed. So the entire 915 will be 9,50,000 will be the current year charge. That is what we are saying. The journal entry will automatically debit employee benefit, credit the liability in the first year 3,16,667. Second year, the liability debit 3,16,067. Employee benefit expenses 3,16,000. Third year, employee benefit expenses debit 9,50,000, credit the liability 9,50,000, and liability is settled. So suppose in this example we are saying that they are having the option, so shares should be issued. So the liability will be debited and share capital will be credited. Okay. And what is our next point? Before we go into the next point, I think I will see. Okay. Before that, what we will do is we will take a small break for 5 minutes and we will come back. It is 8:45, 8:45 according to my watch. Once you come back, what I will do is before going through the slides, I will answer all your questions which has been posted as of now, and then we will take up the balance slides and come back to the balance 3 Excel sheets which we are having. In the Excel sheet problems which we have done, if you have any questions, post that question also, right? We will take 5 minutes break and we will come back on seeing this particular situation. So I am now going to share my PPT for the next point of view. And I will I'm very, very sorry that I have not saw that the Excel file was not visible because the problem which I'm having is that I have to manage the PPT from one sheet, and once I have moved out of PPT, again sharing has to happen. And confirmation should come from your side whether it is happening or not. So I have actually asked the service provider. Once he has not confirmed, I understood that it is coming in. But what I have seen is that you have posted in your Q&A box. So on that basis, now I understand that some of these screens are not fully visible for you. Don't worry about it. Now what I have done is I have taken the questions also live, and accordingly I should have done that. I might have seen that it's not visible. Don't worry about it. Let me first answer those questions and then I will go through this also. And one of you have asked, first let me know whether my Excel screen is now visible. Then I will proceed. Otherwise, I will believe that it's visible and then proceed. Just post it. It's visible, right? Mansuk, the problem is I was actually listening the confirmation when the PPT is changing, whereas they can post only in the question box. So I was not parallelly uploading it because only after 15 minutes or 20 minutes I am doing it. So if somebody can help that, that will always be better. Because when I'm coming to share Excel sheet, the screen sharing is completely changing. When I'm going to PPT, then the screen sharing again has to be confirmed. If some of your people are there, ask them to confirm whenever I'm asking that question. Because they have lost more than 15-20 minutes of my presentation because I'm only explaining numbers without even, I was thinking that I'm explaining the numbers. Okay, now it's visible. Okay. So now I will go to the questions which has been asked by the people, and some of the questions which I try to understand is basically what is the illustration. That is the reason why I took a little bit of time. I will start coming by one of the questions. Sashi Kumar is asking the question on yesterday's. My question is, what happens to share-based payment reserve at the end of choosing? We are always debiting share-based payment liability, and what happens to the balance 3.6 lakhs which we have kept? That was the question. Sorry, in the first question it was 40,000. What happens? I have explained that in full, as I have explained to you now, that 40,000 is the equity component of compound financial instrument as per Ind AS 109. That's the reason why it took so much of time. That 40,000 will be transferred from this to your retained earnings. Somebody has asked a question, why can't it can be transferred to capital reserve? You can do that also to capital reserve, but my feeling is the appropriate situation will be your retained earnings, because you have already debited this 40,000 in the P&L. Okay. So to that extent, it is not a capital item. It is actually a revenue item, but the revenue item is not allowed to be reversed. So that is the reason why I am preferring to change it to retained earnings rather than capital reserve. That's a more appropriate scenario, because Ind AS is normally saying that where the debit has happened, the reversal should also happen there. That's a basic principle. That's the reason why I used retained earnings. Capital reserve, if you are doing, that is another form of equity. It's not an issue, but more appropriate will be retained earnings. Okay. Sanjeev is asking, fair value determination under Ind AS 102 does not cover Ind AS 113. I will tell you why. You are simply taking a price, right? And we will come to that. When we are talking about fair value of the option, we assume that the fair value of the option as if it's a quoted market price. Okay. Fair value of the option is determined as per Ind AS 102. There are 2-3 slides after that we will have the discussion. Because the fair value is not straight away the active market price, it is one of the component. That is the reason why it excludes from the scope of Ind AS 102, and we will be doing only as per this standard and not 113 fair value measurement. Why unidentified services can't be received from employee? See, the entire reason why you are giving bonus, entire reason why you are giving employee stock option plan itself is an unidentified item. But unidentified asset is what we have discussed, if you remember that, when we are talking about the other people. So everything is inbuilt. It's like a self-generated intangible asset. No, all your expenses are already included in that particular aspect itself. So whether it is identified or unidentified, it is taken into consideration. Since you are not able to put a fair value, you are taking it from the fair value of the options which you are going to give, right? That is the reason why, Sanjeev. Unidentified goods and services, if you recollect, I have given an example in respect of non-employees, where assuming that you are purchasing a car and you are paying a price for the car, say 5 lakhs, and they are saying that you are also entitled for 3 years maintenance free, and that maintenance they are not saying any charge, it's a zero. I'm just giving an example, right? So when you are taking that 5 lakh plus zero, you are assuming that the entire 5 lakhs is attributable to the value of the car. Whereas India always sees that when something is given free, whether there is a fair value available for that. If it is available, attribute to that value also. So in this case, this is an free service which has been given. That is an identified goods. In this case, it's a service. That is what the example which I have given in the previous yesterday also. Stock option and share option, there is no difference to my mind, because in India we are always using the word share. That is the reason why we are using the word share. Stock option is also share only. To my mind, there is no difference between these two, Sanjeev. Then we have identified goods and services. Dipesh, what I have explained to you, I have explained for the question raised by Sanjeev. In illustration 3, if the cash settlement is more than the equity settlement, how it is accounted for? Cash settlement is more than the equity settlement. Normally it cannot be, because the way in which you are working out, it will never be, because it's a residual category. So it's a hypothetical question, so it will never be a scenario. Subham is asking the question, when we are talking about, don't you think we should provide entry for 1,53,000 in case it got equity settled, as it was fair value as on the start date? We did the same in question 1. So this is relating to question number 3, if I am not wrong, right? In question number 3, this is not equity settled. The question number 3 itself is giving a cash alternative. You remember that there are 3 methods: equity settled, cash settled, and with the cash alternative. The accounting treatment differs based on what is what. When you are saying that it's the cash alternative, we are trying to find out who can exercise this particular option. So when we are saying that it will be exercised by the other party, the accounting treatment goes based on cash settlement rather than equity settlement. That is the reason why we are not passing that 153. Most likely you might have understood when I have explained that example again for you in the morning. Manoj is asking why we are considering 2 years for both the option available. So cash alternative as well as this, we are only talking about the minimum period of service period is 2 years. After that it automatically vests, right? So that is the reason why we are taking 2 years for both the cases. And another question which comes in is that, from that 726 onwards, you are not able to see full screen. Very, very sorry for that. Sushmita, sorry, I have used some Pushpak is what is the name I have used. Very sorry. I could concentrate only on this. So sorry for wrongly mentioning your name, Sushmita. But you have created a big impact on me Because of that, I have went into doing a big research yesterday, whether I am making an error or the textbook is having an error. If there is an error in the textbook, I have to escalate to Board of Studies. If I understood wrongly, I should get corrected. So thank you very much, Shushmita, for making that to happen. In fact, otherwise I might have missed the concept of talking about the compound financial instrument also. Madan, I have explained capital reserve is not an appropriate transfer. Okay. Ahana is asking, during settlement when cash alternative is opted for the equity portion that has been recognized will not be given to employees, how do we close that expenses? So expenditure is the total amount, right? That is already debited to P&L. But the consequential amount is sitting in our other component of equity. That's what we have seen. So other component of equity will get closed by transferring to retained earnings. Expenditure will not get reversed. Credit the equity account is 3.6 lakh by passing an entry of 1.08. There will be a mismatch in the equity account, right? No. Because I think if it is not correct, wrong, this is relating to the question number 4. In the illustration, we are assuming cash settlement or equity settlement. There are two options which is available. If it is cash settlement, what we are going to do, the entire liability which we are keeping will be transferred as cash, paid in cash. The liability is extinguished. If it is going to be issued in shares, then equity shares will come into the picture. That is the reason why the entire amount is considered and not just the 3.6. The 3.6 is a compound financial instruments equity component as per 109. Don't get confused, because I was actually having only one option yesterday. But when we are looking into the textbook, they wanted to communicate that if you opt for equity settlement, what is the entry? If you are opting for cash alternative, what is the entry? And accordingly, this will not result in a mismatch because the entire expenditure is already accounted for, and that entire amount is going to be adjusted by means of issuing shares in this example. And accordingly, what is given in the textbook is correct. To make it more clear, I have passed other entries also. The first option, what is the 2 entries which has to be passed? In the second option, what are all the 2 entries to be passed? Of course, it's not 2 entries, one single entry, we have combined that. Okay. So accordingly, taking the 3,60,000 is not a correct adjustment. 3,60,000 has to be moved to retained earnings. So this is the reason why I have passed additional entries for you to make it clear. And thank you, sir, for making that I have made it to be accounted for. If equity portion, Ahana is asking this question, if I am not wrong, the same answer. If equity option is taken, that should not be total to be transferred to equity. That is 10.78 minus 3,60,000 and 360. What happens is, this is the confusion which we are having also, because the liability is nothing but only 1 crore 8,078. 1 crore 8,78,000. This 3,60,000 is nothing but equity component of the compound financial instrument. Accordingly, this is not going to be converted into equity, because you are saying that what I will give is nothing but the total fair value as at the end of the exercise period. So to that extent, it will not, 360 will also not get transferred to equity. It is other equity to other equity. Sushmita is asking, can this condition include both service and performance condition at a time? So normally what happens is, if you see the allocation, Sushmita, starting with the vesting condition and non-vesting condition, in the vesting condition, the first question which is asked is, do you have only one condition? That is relating to period of service. Then it says, take it as your service condition. If it is not there, it says that you have to take it as performance condition. And the moment you have concluded that as a performance condition, you have to go with that accounting principle. You cannot go back to say that I will also apply service condition, I will also apply performance condition. It will give a wrong answer. That is the reason why they are very clearly saying only period of service. If it is only period of service, you will get that uh, uh, into a performance condition. So the accounting treatment will move a change. Neha is asking, in case where the entire option is settled with equity, why equity shares are not issued at their fair value on excise date? See, what is the total liability which I am supposed to give? I have committed for a liability, right? If you wanted to consider the fair value of the shares, then what will happen is again there is an adjustment which you have to take it to P&L. Okay. Whereas in share-based payment on the date, what is the amount which is sitting in your liability is getting converted into shares when there is an alternative which is given. Okay. In the initial stage where it's fully equity settled, we are starting with the same thing because it says you should not true up the estimate. It should be based on the date on which the option has been given. Okay. So that is very clear according to the standard. That is what the answer. 100 million revenue condition is not linked to year and the second year. So how it is performance based vesting condition? So if you really look into that condition, if I'm not wrong, this is which example which you are talking about. You are talking about 100 million revenues. We will see that what is that 100 million revenue. Because you have not mentioned which is the number, I'm unable to check what is the question. I think it is in PPT. We will look into the PPT because it's when we are saying it is an EBITDA, it's a non-market condition. So it is not market condition. If it is a market condition, then you will decide what has to be done. When it is a non-market conditions, you have to decide what is the option which has to be taken into consideration. Let us look into that. Accounting treatment for non-vesting condition. Non-vesting condition does not make any impact on the number. Fair value is there and it doesn't have any impact because only for the number of people who are entitled for that. Suppose if the people will not be stay in this organization, then we are looking into that. Otherwise, it will not have any impact. We are having one question which is coming. Can you have a separate PPT with all the illustration? What I will do is, because we lost more than 15-20 days, 20 minutes without the Excel sheet being there, I will share the answers also in the Excel sheet, which will contain the formulas as well. So you can actually find out how the formula is linked. And in case if there are further questions, you can always share with me. I will do that. Presentation not visible. Presentation not visible. Okay, concept has been made clear. The screen is not coming in. Excel not visible. Illustrations I have already told that I will share that. Able to follow the example proceeding file. Illustration is not visible. Sorry for not having this. But two things which I will tell you is that the illustration is from the study material, and accordingly you can have a clarity also with whatever I have explained. And what you can also do is that I will share the Excel sheet along with the formulas how the calculation has happened, so that you can identify whatever I have explained along with that. So that's the way in which I can share you the timeline. Now I'm going to do Rahul, thank you very much. Impact of condition example, please show one more, as then the PPT was not clear and we should not understand. Okay. So impact of conditions, you wanted to show one more. I will show that. Now what I am going to do is I am going to remove the screen on Excel. Now you post it when the PPT is going to be shared, whether the PPT is shown on your screen or not. Just post it so that I can find out whether I can proceed further or not. Okay. You are wanted to know what is the type of conditions and summary of the conditions. So I will just show that summary. This is what we have seen. We are seeing that if there is a fair value of share-based payment, how to determine the fair value of the share-based payment? The service condition should not be included, but to determine how many number of options or equity shares which will vest, we will take the service condition. How many employees will actually entitle for that, depending upon whether they have met the service period which has been prescribed. And the second one is performance condition, which is market related. The share prices of the company in the market should increase by so much of percentage. In that case, we should consider in determining the fair value, no further true up will happen in the subsequent period for the number of shares which are entitled. Even subsequently, it is not, the performance is not met. For example, in one of the case, we said 22% it has met and 19% it has come down, but we have not changed it because it is based on the market condition, which is determined only for fair value. And the third one is non-market condition. Again, to determine the number of shares which will be vesting, we are looking into the non-market condition. If it is a non-vesting condition, it will not have any impact on the number of shares which will be vesting. It will be used only to determine the fair value at the initial period. That means, suppose if I am saying there is no conditions at all, I will issue 1,000 shares after 2 years. After 2 years is what is my thing, and you need not be in employment. If you are today in employment, you are entitled for this after 2 years period. So in that case, you are going to measure your fair value on day 1, that is on the grant date, and accordingly only for that you have to use it. Subsequently, it doesn't have any impact. That's what I have explained to one of the question came from Sanjeev, that it doesn't make any impact on the subsequent true up of the items with respect to non-vesting condition. Okay, let's move on to the next one. We are talking about certain timeline within which it has to be accounted for, because the way in which the study material has been explained, they wanted to explain the concept and related accounting. That's the reason why I also followed the same principle. Whereas the normal way is I normally explain the entire theoretical concept and then go. But the material flow was the better flow, so I have changed all my presentation in accordance with the material. That's the reason why even before the grant date, why we have accounted over 5-year period, 3-year period, 2-year period or 1-year period is because the standard says that you have a timeline within which the accounting should happen. What is that accounting to be happen? It talks about 3 periods, 3 dates maybe I can say: grant date, vesting date and exercise date. Grant date is the date on which, and of course I will first talk about grant date, then we will talk about the vesting period. Grant date is the date on which both the parties, employer as well as employee, have shared the understanding and understood the terms and conditions of the arrangement. So both the parties should be known about the terms and conditions, and that is what the date of grant. Sometimes what happens is management might have taken a decision to introduce an ESOP plan, employee stock option plan, but it is not communicated to the employees. So the counterparty is not having any understanding of the terms and conditions. In that case, it is not the grant date. Even though management has passed a resolution, it is known to the persons who are affected and they have also understood that. Then only it becomes a grant date. Why grant date is important? From the date of grant till the vesting period, vesting date, the expenditure are accounted over that particular period. Suppose if the grant date is not happening, say it is happening on 1st of October for a 31st March, then 6 months accounts expenditure will be accounted in the first year. Suppose if it is happening on 31st of March, then only 1 day expenditure will be charged, because a grant date is the date on which the expenditure or the liability or the obligation starts with respect to the employer share-based payment transactions. Okay, grant date is very important. We have to determine that grant date. And the second is vesting date. What is the vesting date? There is a period which is being given in the particular agreement. So for example, it says that there are conditions attached to that. If there is any condition which has been attached to that, then only on fulfillment of that conditions, the employee is entitled for that benefit or share-based payment. So accordingly, what is the date on which, within which they have to fulfill that condition? That is the vesting date. Once you fulfill the condition, it is vesting. For example, in some of the Excel sheets which we have seen a case where we said that you will have vesting on first year so much, and second year so much, and third year so much, based on what is the number of employees who are there. So some of the employees who have met the conditions in the first year, the vesting condition has been fulfilled, are expected to complete. In the second year, some people have actually left, some people are estimated to be left. So we have reduced that portion also. So we are trying to find out within the vesting date, 2-year vesting period or 3-year vesting period, we are trying to find out what is the date up within which the condition should be fulfilled or satisfied. If it is satisfied, between the grant date and the vesting date, the period is called vesting period. What do you do with the vesting period? During this period, it is expected that all the conditions specified are to be satisfied, and the expenditure has to be accounted during that particular period. That's the reason why we are talking about vesting period. From the grant date to vesting date, it will be accounted based on whatever we have seen in the example. If there is no change, straight line. If there is a change based on the entitlement, we are truing up the estimate, and cumulative adjustment is being done in the subsequent period, because it's a change in estimate on a prospective basis, right? Now, what do you mean by exercise date? You have fulfilled the conditions relating to the stock option plan, but exactly on one particular date you have asked to issue shares. You have exercised that option. You have communicated to that. On the date, the share or employee stock option plan reserve will be transferred to equity. That is what exercise date. And the exercise date will also be the date on which, if it is a cash settled, the payment has to be made. The liability will be removed. This is what the period. Date on which it is exercised, maybe as a equity settled or as a cash alternative, it is going to be paid. This particular slide, you always keep it in your mind. Then it will answer all your questions relating to the entire concepts of grant date, vesting period, what is the accounting period within which the expenses to be accounted for, is it straight line or it is to be trued up, and what is the date on which the liability or the equity will be extinguished. Okay, this timeline. Grant date, this is a crucial date, and normally there should be an agreement between the employee or with the supplier. So where you are agreeing with the terms and conditions of that. So when we are talking about this, sometimes this agreement may be subjected to approval of a higher authority. For example, board might have taken a decision. Over and above the board, there is a supervisory board. In some group of companies, they will be calling as a supervisory board. The terms and conditions says that from the date it is approved by the supervisory board, it will come into the picture. That means passing by the directors, approving by the directors, and making it known to the employees, it's not enough. Approval by the supervisory board is also required. That's what it's being saying. If you are saying yes, supervisory board is required, then the grant date should be taken into consideration. I wanted the example of impact of condition. The answer to the examples are not given in the PPT, and when you are explaining the screen, it was not visible. Please share that. That's what I have shared, right? Is it possible there may be a situation where purchase date and grant date are different? Purchase date, Sanjeev, can you explain what you mean by purchase date? Then I will explain that. I'm not sure. Are you talking about purchase date means when the goods are received from a third party, whether that date will be different from the grant date? If you are asking, normally in that particular situation, this might have been already approved. Both the parties are knowing with each other what is the terms and conditions. So I assume that the purchase date which you are talking about, when I am dealing with a third party, whether the terms and conditions which we are talking about is on the purchase date or there could be a different grant date. Normally will not be there with respect to third parties because third parties wanted to understand what is the terms and condition in which they will supply. It will be known to them previously and the agreement will be executed on a particular date. That will become the grant date. Okay, purchase date and grant date will normally go together in respect of, I should say, what you call a third party. Then suppose if there is no appropriate authorities where it is required to be approved, then there is no need for that. The date of agreement which has been signed by the both the parties are enough. Let me take an example for you. Entity initiated a share-based payment agreement in its board meeting and directed that the supervisors to communicate the agreement to the employees. We are going to consider three scenarios to determine whether what is the grant date. So here board has approved it and they have asked the supervisors to communicate to the employees. So the date on which board has approved has to be taken as a grant date, or the date on which they have directed the supervisors to communicate to the employees, or the date on which it is communicated to the employees should be considered as a grant date, or any other permutation and combination. Okay, so let us understand one example. Employees have not given or concerned either implicitly or explicitly. However, the entity has taken the approval in its general body meeting. So what it says is that the parties to this agreement for an employee stock option is the employer, that's an entity, and the employee. Whereas the approval has taken only in the shareholders meeting. Shareholders are not employees, right? Accordingly, the parties have not understood the terms and conditions and they are not agreed to the terms and conditions, and accordingly it cannot be a grant date. So you cannot determine what is a grant date because there is nothing has been given. They have not yet approved it. So we have to wait till the date they have approved it. I mean, they have signed it, given their concern, then we have to take it as a grant date. Another example, employees have agreed it that okay with the terms and condition, but the entity is going to revise that there are some other discussion which is going on in respect of the approval process. It is not yet finalized. Accordingly, it is not reaching a finite terms and condition. It's only a draft at this point of time. And accordingly, this is, you cannot determine unless the entire approvals has been done. It is not an official document. Okay. Draft has been approved by the employees. Draft has been approved by the management, but it is required to be approved by the competent authority. That is still under finalization. So you have to wait for the date of approval, then only you can consider that as a grant date. There are certain conditions, there are certain terms which have not been specifically mentioned since they are subjective conditions. That means it says that the conditions are not explicit. There seems to be some ambiguity with respect to what is the condition itself. Very hypothetical situation. In that subjective scenarios, it is not a conclusive document at all. So accordingly, till such time you are finding out what is the outcome of the subjective conditions, there is no defined terms and conditions, so it will not be a grant date. So in simple terms, terms and conditions should be very, very objectively defined. It should be approved by, so it should be agreed by both the parties, an entity as well as the counterparty, and if it requires any specific approval, that should also be done. Suppose if it is not finalized, then it has to be postponed. We are clear on that particular item. So, grant date fair value, how it has to be determined. Now I am coming to Sanjeev's question, why it is excluded from Ind AS 113. So what it says is that the employee services are measured indirectly by relating to the fair value of equity instrument granted. Fair value of equity instrument granted. So it is an option granted at that point of time or equity instrument which has been granted. But the measurement of the fair value is dependent on a lot of points. So it says that it may be market price with similar conditions, which is the rarest possibility. Now you have an answer, Sanjeev. Fair value of the equity instrument measured at market price of the instrument with similar terms and conditions, very rarely used. You have to go with the fair value of the grant date. How can one identify how much is equity settled and how much is cash settled in three illustration? Very simple. If it contains both the options, you have to see, if you go through the item which we have seen in the yesterday's session, we said if it is combining equity settled as well as cash settled, you have to see who will exercise the option. If the counterparty will exercise the option, it has to be accounted as cash settled. In cash settled, to determine what is it's a compound financial instrument. That's what it says. That is the reason why we are coming into that. Suppose if entity will decide, then we have to get the approval or what is the intention of the management. If they are saying entity will go for this as an equity settlement, it will be given in your answer. So on that basis, you have to do it, Ajit. Okay. Measured at grant date. Okay, it should be measured at grant date. If no market price is there, you will actually go for an option pricing model. The option pricing model, when you are talking about how you will, and of course, expected charges we have already seen. What is the total number of options? What is the grant date fair value of one option? What is the percentage expected to vest? Is the total value. And the assumptions made by the management will affect this number significantly. Somebody has asked, I have missed about the accounting for the conditions, right? I have already shown that. Again, it is coming here. Grant date fair value determination, you have to consider market condition as well as non-vesting condition. It should not be trued up subsequent to the grant date. Okay. Percentage expected to vest, service conditions and non-market conditions should be applied. You have to true up the obligation at every period of time based on this to estimate. So now you are clear on that. I was thinking that whether I have to really go back to the previous slide and explain. Fortunately, there is a repetition as a recap which is coming in. When there is a modification in a particular scheme which has been approved, there could be two scenarios. One, it is beneficial to the employee. That means employee will get something more than what was originally given in the first scheme. There was an employee stock option scheme 1 which has been introduced. Now they wanted to modify the terms and conditions of that particular ESOP 1 plan. When they are changing the modification, whether employee will be benefiting from out of it and he will not get benefit out of it, based on which the accounting treatment changes. Please understand, beneficial to the employee is what we have to consider, not beneficial to the employer has to be considered. Okay. If it is beneficial to the employee, assuming that the modification, terms and condition that is changed beneficial, the incremental fair value should be included in the measurement. What is initially fixed now goes for a change because I am modifying the terms and condition. There will be a possibility of increase in the fair value which will be beneficial to the employee. Then I have to take that also, and that should be included for accounting on a prospective basis. Additional charge will come to the P&L on a prospective basis. Suppose if I say this benefit is not increasing the fair value, but it will increase the number of shares to be granted. So what I have to do? What is the number of shares to be additionally granted into the fair value which originally we have fixed should be included in the valuation and again charged to the P&L account. That's what exactly it says. I have to consider that as on a prospective basis. The vesting condition is beneficial to the employee. Suppose 3 years is the vesting condition which has been given. Now it says that even if you completed 1 year, then you can do it. So normally 1 year, within 1 year there is no modification which will come in. So I will take a different example. That will be an appropriate example. Assuming that we are talking about 5-year vesting period. On the 3rd year, the entity decides that no, there is no need for you to fulfill 5 years. If you are fulfilling only 4 years, that is enough. So again, it is beneficial to the employee, right? And accordingly, how many employees are expected to complete 5 years is your original estimate. Remove that estimate. Instead, make how many employees are expected to complete 4 years. Maybe some additional number of employees will expected to complete. To that extent, additional charge will come into the P&L account. So if it is modification, there is an increase which is going to happen either because of fair value, either because of the number of shares which going to be issued, or either because of the vesting condition is reduced. It is becoming beneficial to the employee. In those conditions, you will revise this measurement and make a prospective adjustment. You will not go and restate the number. Whatever cumulatively you have already accounted minus the new one, new cumulative number, difference goes to the P&L in the current period. And of course, whenever there is a change in estimate, you have to explain both as per Ind AS 102 as well as Ind AS 8. So you will do that. Ajit is asking another question. There may be possible to take 50-50 equity and cash settlement. Then I can give difference of equity and cash settlement in illustration 4. Possible, Ajit, in that particular situation, we will be able to determine what is the amount to be determined in equity and what is the amount to be cash settled. It is possible. But normally what it says is that this option to exercise 50-50 will be known on day 1 itself, because it is an option given to the other party, and the other party, what is the option available to him, we are estimating, and accordingly 50% you can exercise an equity and 50% as cash entitlement. We are predetermining that. So right from the beginning, 50% will be equity settled and 50% will be our cash settled. So straight away it is coming as a 2 different plan. What we have seen in our example 4 and example 5, etc., there is an alternative for settlement. We are not saying exactly 50-50. We are saying either cash or equity. If you opt for at the end of the period cash or at the end of the period equity, not 50-50. If it is 50-50, it should be known to them at the beginning of the period itself. Okay, if it is beginning of the period, I will consider it as 2 different plans. One equity settled plan, another is cash settled plan. Accounting will be done accordingly. I think you are clear on that, Ajit. Suppose if the modification of the existing plan is not beneficial to the employee, any reduction in the fair value will be ignored. That means whatever is the original benefit which I am going to pay, I will continue to account on the same basis. I will not reduce that as a change in estimate. Similarly, if I am saying it reduces the number of shares eligible, what I will do is I will consider the cancellation of the balance number of shares as a cancellation in this agreement. What the standard says is, if there is a cancellation of an existing plan, you have to always consider that it is an accelerated fulfillment of vesting condition. What does it mean? 5 years is the period which I have determined, but on the 3rd year I am changing the terms and condition. Because of that, the number of shares which I am going to grant to the employee will come down. what it says is that because it's not beneficial to the employee, you have to consider that it's an accelerated completion of your vesting condition on the third year itself. The cumulative balance will be accounted as your P&L in the P&L as an expenditure because it is an accelerated charge. Okay, so that is what it's saying. So it should always be beneficial, and if it is not beneficial, you have to account for that in a similar scenario. If the vesting conditions have been changed which are not beneficial, modified vesting conditions will be ignored. So you have to continue with that same old conditions, whatever is there. Only accounting treatment will change when there is a cancellation or number of thing is coming in, accelerated vesting is coming in. Jitin is asking a question, what the Ind AS are on income statement? Jitin, I am not able to understand what exactly is your question. What Ind AS are on income statement means, is it you are talking about P&L account or you are talking about anything? Is it a general question? I am not able to understand. What you do is please put full question again and I will be able to answer that question, Jitin. As we will take one example of modification. Now what I am going to do is I am going to share an Excel sheet. Once the Excel sheet is visible, please answer in your question box that yes, the Excel sheet is visible. Otherwise, I will go on explaining, but you will lose the benefit of it. Let's take this example. Whether this Excel sheet is visible to you. Hello? Can I have somebody to answer whether it is visible? Otherwise, another 10-15 minutes I will explain that you will lose the benefit. Is it visible or not visible? Excel file is visible or not visible? Nobody is confirming to me. So on that basis only I have assumed that it is visible. Is it visible or not visible? Again, the last time I am asking this question. If no answer is coming, I will assume that it's visible and I will proceed further on this. Okay, I will assume that it's visible on your screen. It is illustration 9 where an entity issued options to each of its employees. Number of employees are 1000. Granted share option is 150. Service condition which has been given is 3 years. Service condition which has been given is 3 years. Fair value at the option on the date of grant is 129. Okay, it is visible. Good. True up is nothing but Mukesh is asking a question. What is true up? True up is nothing but a change in estimate, right? Previously I have estimated as, for example, in this example also, I will just show the number to understand what you mean by true up. See, first year my liability is 58.37 lakhs. Second year, this is 57.59 lakhs. Okay. So the difference between these two is arising out of modification. I will just re-estimate that number on a prospective basis. That's what we are using the word true up. True up is nothing but this one. Non-beneficial to the employee means because of the terms and conditions, the employee will get a lesser benefit compared to the previous terms and conditions. That's what non-beneficial. Okay, let us take an example. Equity settled. Again, please understand it's an equity settled share-based payment. If it is a cash settled, our accounting will be different. If it is cash alternative, the accounting will be different. In cash alternative, we will think about whether it's a compound financial instrument or not. In this case, I am talking about equity settled share-based payment where there is a modification which is happening in the scenario. What is the modification which we are talking about? 150 is the grant date share option and 1000 is the number of employees. Number of years the employees to serve, original condition is 3 years. Fair value on the date is 129. At the end of the first year, number of employees left is 35. So you have to reduce from 1000, 35 first. And who are expected to leave is another 60. So that should also be reduced for arriving at how many people are entitled for it. And fair value of the share fell to 50. Okay. When it is a equity settled and it is only a service condition, then whether this number has to be, fair value changes has to be accounted for. If you see that, we are only going to account for the number of shares which are going to be changed. That's what right from beginning we are saying. And what they have done is they have repriced the share. This is the terms and conditions which are changing. Because of the reprice, it comes to 80 rupees. Previously it was 50 rupees. It has now come to 80 rupees. Because of that, 30 rupees of expenditure is increased. When we are saying that expenditure is increased by 30 rupees, beneficial to the employees, right? Because employee will get the benefit. Because of that, I am increasing an expenditure. It is beneficial. At the end of the first year, another 30 people have left, and people expected to leave the organization is another 36 people. So that is also to be reduced. And at the end of the year 2, actual people left is only 39. So when you are working out the number, the number of employees who are initially considered should be considered only to actual 39 people plus what is the people who have actually left in the first year, and what is the people, I think that it's second year. Let's just see the number of people who have left is F22. F22 is nothing but your, okay, this is at the end of year 2. There's an error in the calculation. Okay, so now we will go into the understanding of the example. What we have said, the repricing has been done at the end of year 1. Hence, the increased effect will be spread over the next 2 years equally. That's what I have said on a what do you call, Sanjeev, I will come back to your question, repurchase option. I will come back to that a little later. First, I will complete my session and then I will come back on this particular question. Repricing has been done at the end of the 1 year, and hence the increased expenditure, which is beneficial to the employee, should be spread on a prospective basis for the next year. So, the increase due to the variation is nothing but 50 rupees of original fair value minus 80 rupees of revised fair value, which is 30 rupees, and we are going to account it. To determine the service period, we said fair value should not be get into consideration, but we have to take into consideration what is the number of employees who are eligible based on the service condition. That's what we have seen in the columnar table which we have seen. What is the impact of the service condition? Originally number of employees are 1000. First year left is 35 and actually expected to left is 60. So 905 people are entitled. That is my total obligation based on whatever is the assumption which we are having on the first year. On the second year, 1000 employees, original number, out of which 35 has already left. Another 30 has left subsequently. So we have taken that also. And the expected to leave as 36 we have taken. And additional people who have left is another 36 people. So we are taking the entire thing. Mukesh, I will come to non-beneficial to the employee. First, let us understand beneficial to the employee with this illustration, and I will explain what is non-beneficial to you. So in this example, what is the option which is available per employee is 150. So fair value on the date of option, not subsequent to that option. What is the fair value on the date of option is original value 129 first year but I have to give only 1/3 weightage because it is to be done for 3 years period. I have taken that as a 58.37 lakhs, which is nothing but multiplication of number of employees into option per employee into fair value and for the weightage of 1/3. This is accounted as my expenditure on employee cost with a liability towards share to be issued, not it's not cash settled. So I will show that as a share reserve. Okay. Second year they have done the repricing. Because of the repricing, 50 rupees has gone to 80 rupees. Additional 30 rupees goes to the benefit of the employee. So what I have done is, for the understanding, I have split that into two so that you can also have that. 58.37 lakhs is fine. But in the second case, how 57.59? Somebody has asked, what do you mean by true up? True up is nothing but number of employees is 899, 150 per employee, 129 is the original fair value. 2/3 should be the total amount to be debited up to year 2. But I have already debited 58.37. Balance I am adjusting entire thing in the current period. So the impact of the reduction in the number of employees are getting captured in the second year. That is what we call it as a true up of the estimate based on actual revision happening in the second year. That's what the answer for the true up also. Okay. So what is the charge for the current period? Original amount, and what is the additional liability because of the beneficial component? The total debit to come to the P&L account will be charged. For example, in this case, what I have done is I have considered 150 into 899 employees, and increase in value is 30 rupees, but that is to be spread over 2 periods, right? Current second year and third year. So I have spread that into second year and third year with giving a weightage of 2 years. So that is divided by 2. I have done it. Then in the third year, what is happening? The number is still going down. So original calculation has been done on the same basis. 896 employees into 150 per employee, the option, into 129 original fair value, into the weightage which has to be given is for the full period, minus what is cumulatively recognized in the first year and second year is the charge for the original value in the first year. Original amount based on without modification in the third year. Now I have modified, that is beneficial to the employee, so additional charge also to be considered. What is that additional charge? 30 rupees per employee on 150 options into the number of employees, that is 896 into 150 into 30. Here the weightage will be full year minus what is already accounted. 20.22 lakhs has been accounted. So if I am not adjusting on a true up basis to make you to understand, this figure should remain constant in both the periods, right? 20.22 lakhs and 20.09 lakhs, both should be remaining constant in both the scenarios. But what we have done, the impact of the people who have left but not fulfilled the condition, we have adjusted on a prospective basis by revising our estimate. Revising our estimate is what I have called it as a true up. Okay, now let me go into the question. Vandana, you are also asking about a reload condition. We will, Sanjeev is also asking that reload condition. Let me open up and then discuss about that reload condition because you are mentioning something from the study material. I will look into that and answer finally. The non-beneficial to employees, treatment in case of reduction in the number of shares. What will happen? Reduction in the number of shares, we will assume that the existing number of shares which has been offered will be accelerated to get vested in the current period itself, and the entire charge will happen in the current period. That's what we have seen in the second scenario. And another question which we are talking about is Mujira is asking the question. I have doubt in yesterday's class in the third illustration done yesterday, the share-based payment with cash alternative, we have recognized 40,000 in equity reserve, but as we settled with cash option, this reserve remained bus. We have spent so much of time explaining that with illustration, right? So you are still sitting on that. That means you are either joining now or you have not looked into that. You remember that I have specifically talked about this as a compound financial instrument, explaining Ind AS 109, etc. Please go back and recap with the recorded video. Okay. So what happens, somebody has said, there is one case of cancellation which we have seen, right? In the cancellation, what happens is it is considered as an accelerated vesting. So let us take this example. So I think that we are missing our timeline. I have answered all your questions. So what I will do is I will just go back to our PPT. You can have these two illustrations on your homework. And in case if you are getting into a problem, you please come back to me. In whether the PPT is now visible to you, can somebody has post it on your screen quickly so that I can finish off the balance portion quickly in another 5 minutes time. Then we will look into the other questions and other illustrations. But you can go through the illustration 10 and 11. The option pricing is actually given as a model in the standard. This is what we call it as a option pricing model, normally a Black-Scholes model. I wanted to show you a Black-Scholes model illustration also, but don't worry about it. You can just Google out and you can find it out from that. What I will do is I will also share one Excel sheet where we have done Black-Scholes model option. But I must tell you that this particular option, whatever you are seeing, option pricing model, is normally not expected to be done as part of Ind AS 102. In my view, this will come as part of your SFM. In SFM, there is an option pricing model where you will talk about the various options, like what is the exercise price of the option, what is the life of the option, what is the risk-free interest rate, what is the net present value. All those things you will calculate in your SFM. So it will actually what you are supposed to take into consideration. Here I am saying that these are all the minimum to be included. You can fine tune by taking the net present value, etc. as an additional items. Okay. In case of cancellation, what has happened is it becomes as an acceleration of vesting. That means the balance amount of liability is debited to the P&L account with a corresponding increase in the liability. That is the excess of the fair value measured on the date of repurchase. Now somebody is asking about repurchase. Repurchase is also happening when they are cancelling the particular item, or they are saying that I am purchasing the option back even before the date of this. So in that case, what is the excess in the share price that should be accounted for in the P&L account? Suppose if you are replacing the existing grant with a new one, that will be considered as a modification. We have already seen what is modification. If it is beneficial, incremental fair value will be accounted for. If it is non-beneficial, it will be ignored. Group arrangement, only thing which I wanted to consider is very simple. Assuming that the group entity, employees are working in entity A, but the shares of entity B, which is a parent company of entity A, has issued the shares. In that case, accounting treatment or expenditure to be accounted in the entity which received services. So we are talking about A Limited, which receives services, receiver of services, and B Limited issues shares. Okay, there could be two options, two possibilities. One, B charges the equivalent amount to A as a debit through a debit note or any other claim. In that case, it becomes a cash settled because I have an obligation to pay to B Limited. So I will debit the whatever amount which has been charged to me by means of the debit note, debit that to employee benefit expenses, credit to liability, and the liability when it is settled, it is squared up. Suppose if it is not charged back. Parent company gives the shares, but it is never debiting the subsidiary company. In that case, what is considered is that still you have to recognize in A Limited, which is receiving the goods and services, should account that as an expenditure in the profit and loss account, and credit should be given as a capital contribution from the parent company. But actual share capital is not increased. Because of that, it will be shown as part of other equity, considered as a capital contribution because it is not charged back. Okay, debit is not coming. There is no obligation to settle. So accordingly, it is considered as a capital contribution. That's the only difference. What we are saying, if there is no obligation to settle, this will be considered as a capital contribution. If there is an obligation to settle, it will be recognized as a liability till such time it is actually settled. That's the only scenario. Based on the category, it is summarization, whatever I have talked about, whether it should be treated as equity settled or cash settled. Accounting treatment will go into the equity settled and cash settled basis. Disclosure is very simple. Whatever you have done, you are going to explain that. It's a theory part. You can actually look into that. What I will do is quickly I will recap what is the difference between Ind AS and this. Anyway, we have done that. What it talks about, it is covering a detailed guidance for employee as well as non-employee. Whereas we don't have an accounting standard for employee stock option plan. It is only a guidance note on employee share-based payment. That means payment to outsiders are not covered by the guidance note. There is no equivalent standard, only a guidance note is available. Every share-based payment should be recognized as per fair value according to Ind AS 102. We said intrinsic value is very, very rare, whereas guidance note allows both measured under intrinsic value is actually wrong. Also measured also under intrinsic method, because you have fair value method is one option or intrinsic value method is another option. This is what the guidance note says. You can do that, but a lot of companies have used pre-Ind AS scenario only the intrinsic value method. That is the reason why they have avoided a lot of debit to the P&L account. That is what left out. Now PPT is visible, everything has been done, and only one question which I have not answered. What is a reload or something like that? I am actually not going to show any PPT at this point of time. I am just going to open a PDF file which is your study material, because I have not specifically concentrated on the reload or repurchase option. I will just spend a quick time to understand what the way in which I can explain. So don't worry about screen, only I will be visible on the screen. What you talk about reload, it says a feature that provides for an automatic grant of additional share options whenever the option holder exercises previously granted options using the entity shares rather than cash. So in simple terms, if it is an equity settled, in case, for example, you have both cash alternative as well as equity alternative, both are given to them. And in one of the conditions which I am saying is that in case the employer, the other party has decided to opt for the equity option instead of cash settlement, I am giving an additional share option as a bonus, because I don't want to have a cash outflow, but I wanted to convert that into an equity. So I am giving an additional shares. That additional shares is what is called as a reload option. So that is what you are talking about as a reload. So that additional share option should also be taken into consideration in determining your expenditure. Then we go with the So suppose if there is a cancellation or settlement of a grant, there is a concept called accelerated charge, right? So when you are settling a particular item, it becomes your liability. So in case if there is a option which has been given as a repurchase option, it says you have to consider that as a reduction in your capital, because it is not an additional issue. I purchase and close that particular share, there ends the matter. So that is the accounting treatment. So that is also now answered. If there are any further question, please post it. Otherwise, I will give you a very big thanks to all of you for being with me for more than how many days? In days 1, we have spent 2 days. We have spent in days 7, 1 day, fair value measurement 1 day, and another 2 days. So 5 days you have spent with me, and you people have done a wonderful work of asking so many questions. In fact, my knowledge has enhanced because of you people, and some of the cases where even it's a hypothetical situation where it is never practically we have handled, we may not have studied that in detail. We might have theoretically applied that, and you made me to look into that. That is also for that also for I should thank you, because it enhanced my knowledge, and I should also thank the Board of Studies for my giving this opportunity of meeting all of you. And you can always be in touch with me, and you can get connected me through the Board of Studies at any time, any question, any standard. I'll always post it to me. It will be my pleasure to answer that question. With that, I will close the session. Thank you so much.